Good afternoon. I'm Roy Weiler, Director of Trading Operations for Time Leverage Capital. For anyone who's missed our previous webinars, please give us a call at 800-519-9085 and we can send you the videos you've missed. You can also browse by topic on the Option Ranger website under Demo Videos. If you're a guest but not yet part of the beta program, please schedule a brief discussion of your current trading knowledge so that we can prepare a lesson plan based on your level, at your pace, and on your schedule. For an important disclosure, please be aware that trading futures and options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Please be sure to read and understand all disclosures before investing. All of the examples discussed today are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If at any time during the webinar you have questions or trade ideas, please type them in the chat box and we'll do our best to answer them. Our presenter today is Mr. Adrian Mueller. He's the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends, an all-markets newsletter. Mr. Mueller is the founder and principal of the independent introducing brokerage, Time Leverage Capital, and a former stock option principal. The program in which you are participating was developed over many years to train professional brokers and to provide user-friendly educational programs for individual investors. Without further delay, welcome to our Granting Put Options, a Premium Income Strategy webinar. Mr. Mueller? Mr. Mueller?
Thank you, Roy, and good afternoon to everybody. Today we are going to be completing the basic step in the number one module, which is for basic stock and basic futures options, the four principal strategies: buying calls, buying puts, selling calls, and selling puts. And today our program is going to be on granting puts. So let's proceed to the scenario under one might consider such a strategy. We go to the strategy gallery in which we define trades and by two specific criteria in order to make a more informed decision about whether the risk and the rewards of a trade factor together in a manner that is acceptable and would make a good trade. So in this particular scenario, we are looking at a strategy. And what would the outlook of this person be? We see here that we are shorting a put or selling a put. So this directionally is a bullish trade. So somebody who sells a put, number one, has to be bullish. And many people have a sense of direction. That's the only thing they do. Selling a put is a different way to be bullish because it takes into account another factor that is not considered frequently enough or seriously enough by investors, and that is volatility. In order to make an informed decision, we want to have a solid outlook both on direction, which can be bullish, bearish, or undecided, but also, and in certain cases even more importantly, on volatility. And that is whether volatility is going up, it's going down, or again, we are uncertain or it's flat. On these particular scenarios, on all of these scenarios, once we come up with that point of view, we can select a strategy that takes into account both of those factors. Today, we are looking at a strategy which is bullish in nature, as we indicated, but is anticipating falling volatility. And there are actually two trades under this category. We have a short put and also a ratio call spread, and these are for falling volatility. Today, because we're completing the basic strategy series, we're going to be using the example of shorting or selling a put, which is a trade in which you expect an upward direction in the market and falling volatility in the market. And we'll go over some of the other parameters of selecting this trade. When you click on that particular position, as you can see, you go into the particulars of the trade directionally. You have a visual here which shows you the type of movement that happens on a chart, which is very commonly seen and commonly misunderstood. The reason most people can't understand selling a put, which is a fairly simple concept, is because they see a chart like this and they don't get to the actual numbers. So what we did instead is we've got a very short description here again. When do we use the trade? If we think the market will go up, okay, or if it stays flat or it goes down, it just won't go to your strike price. The profit amount is limited to the premium collected, so now you have a clear description of the profit scenario. The loss is unlimited. This is a margin trade. You're taking on an obligation to get long a particular instrument if that is put to you. And this is a strategy that, as some of you may know, are familiar with writing puts in the stock market. It's a strategy for either collecting premium, or if a market should drop and the person doesn't want to offset the position, they can actually get an exercise and be put to the stock, own the underlying stock. What we have here is a have a video, and you can see here how long it is, so it's very easy for you to go in there. And for each particular strategy that we have, we are now completing the library with every corresponding demo, which is very short and will be linked to other useful demos. So at any time on your own, you'll be able to click on this and review how to input the trade and review a discussion of the directional outlook on this market. So now let's go ahead and take a minute and look at a market that we will be exploring today very briefly. And it's the S&P 500 index. The market was very volatile today, and obviously when you talk about volatility, which is one of the factors we follow, we want to see how a large move in the S&P 500, or perhaps not so large, who knows what's to follow, how selling a put would operate under that scenario. So now let's go ahead, and I'm going to go ahead and open up the Option Ranger. And as you see, and again, the most recent trades that we demonstrated here were all buying E-mini puts, which obviously on a big down day with rising volatility, we modeled these things out on the 11th, which is just 2 days ago, on the Buying a Put webinar. And these were not trade recos, it was just demonstrating the performance of buying a put at that given time. And we've done examples of calls as well in the past, as you can see here. That was a week before. So now let's go ahead straight to the S&P market. Okay. And we're going to go ahead with our inputs. As you see, once you start typing your symbol, it populates there, and you see we have all the instruments, E-minis, the 400, the S&P 400, mid caps, and so on. Let's go to the 500 index. Again, as you recall, when you click, you immediately get your contract specs in a dialog box, as well as another link that will take you to the contract specifics of the S&P 500. And I think actually I'm going to go ahead and do that, because not only do you get the specifics as you can see on the market, but you get something, and I actually personally compiled this list while working with the Dow Jones writing team over a number of years on megatrends, and this would be all the factors to consider. And of course, this list is changing all the time, but that we have had going into this particular time frame. As you can see, EU stability, all of the various factors are listed here, and many of them go with a link to a primary source. So while, of course, you can go ahead and come up with, and you should come up with an outlook and a scenario that you like, it's very important to have the at least a list of some additional resources that you might want to consider. And again, we go to the primary reports wherever possible inside the link. So now, having looked at all these factors, let's go ahead and return to our example on the S&P 500 index, and our strategy today is selling a put, or as they call it, granting a put. As you can see, a quick graphic pops up with the principal directional points of selling a put and detailing the factors that we listed before, and now we just get a quick reminder that we're still looking for an up direction and for dropping volatility. And we can see quickly by looking at this that time decay favors this trade. If the market is, again, falling, volatility means time passes with very little happening. So under those scenarios, the passage of time will benefit the person who wrote this option, and anybody who's bought an option in the past and has direction hasn't been bad, but they still lost money, this was the reason. When you buy call and put options, you are paying a premium, and you are not just fighting to reach your strike price or to exceed your strike price, but you must do so but you must do so with rising volatility. When you don't, it's the seller of the put that benefits from the passage of time, and it's the buyer of the put that has a disadvantage with the passing of time. So let's go ahead and do an example on a one lot of the, and let's go ahead and the market is at 18, call it 1846, down 21.5. Let's have a look at a June put that is about let's say 100 points down. So let's look for something that's another 5% drop away, 5% from here.
It's like a 1740 put.
I'd say let's look at the 1740. That's a perfect price. Now, as you see, when one clicks on the box, you get an example of how to input the trade. Although the numbers are intended to be intuitive, we nonetheless go ahead and open up this dialog box, and again you have a helpful link here to a further discussion of strike prices and how to select strike prices. Basically, in this particular case, the person who sold the put has acquired the obligation that if the buyer of the put wants they can assign a long position or a buy to the person who sold the put of the contract. So under premium, again, we click on premium, we get a quick explanation of premium, and what is the premium in this case, if you can have a current price?
27.5.
Okay, 27.5, okay. Okay, 27.5, there we are. Let's go ahead and input a default rate, and let's see what happens on a big move. The number of output rows you can adjust based on your parameters, but you can expand them to all levels. Usually I just want to keep things realistic as I look at a trade, and let's see what happens here. Well, first of all, the first thing that opens up is a quick summary box. The strategy, selling a put, the strike price, the premium, and then we immediately have a translation of those premium points into actual dollar amounts, which is what matters. So 27.5 premium points, which was just quoted, is $6,875. Then, of course, we do the basics of the transaction by subtracting the fee, so that we have by adding the fee rather, and now we have the total that is collected, the total net credit that the seller of the put receives. So the person starts out with $68.20 in their account, and they're hoping the market does not get volatile or drop hard against their position so they can keep that money. In simple terms, the bet here is that the markets will stay above 1740, which actually can factor in some of a drop. So although this is a bullish trade, it is a bullish trade with a margin of error of about 100 points, and that's the flexibility of the seller of the option of premium, that although he's bullish, he can give himself some breathing room and still have time erosion work away at the premium and turn the trade profitable, even if it doesn't go up, but just the falling volatility component materializes. So now let's go back to the box here, and we're going to see that basically the break-even point for this person on the contract is at 1712.72. So as long as the market at expiration is above 1712.72, the position is going to be making something. If it's below there, it's going to be losing something. The break-even point is 27.28 premium points, and again, that has already been translated into premium. And the maximum risk of the trade, again, as you can see, the gain is limited to 68.20, the amount of premium collected. However, this is a margin trade. Notice how it's in red. So the risk is unlimited. the position can lose $25 per tick on a move below 1712.72. So a person who sells this put on the one hand is collecting some nice premium and has a cushion. On the other hand, should that cushion prove insufficient, the risk is open on a further drop, and let's see how that looks. As you can see, this person was bullish, betting on falling volatility, and sure enough, as long as the market went up, no matter where it went up, they make money, but they only make their 68.20. So in this particular case, the bullishness worked out, so you see exactly the margin of error. Now, as a seller of a put, because of time erosion and the fact that this is an out-of-the-money option, you'll notice that with the market currently around, let's say, 1845 to round up, if it should go down to 1810, which is a drop, because the option that was sold was out of the money, at expiration, the entire premium collected would still be kept. And that happens to be the case all the way down to the break-even point that we indicated earlier. If the market falls below that break-even point, and let's go back up and see where that break-even point is. Okay, again, it's at 1712.72, so you have to have a basis for thinking the market's not going there, or that it's very unlikely. If you have a concern that you might, you need to look at the red numbers, because as you can see here, although there's a nice margin of error, you can say, well, look at this, I'm still making money at 1733, at 1720, whatever the number is, but then look at the red numbers start to pop up if the drop has rising volatility. So now, not only is the person wrong on direction on this one, on being bullish, but it's rising volatility. Had a person been wrong on being bullish by a little bit, and volatility didn't go up, as you can see, the trade can still win. So it's a trade where you can be wrong on direction and still make money, but in exchange for all that, the person has to take a risk that if there's an extraordinary overnight event, let's say the market finds its way to 1600, intrinsically, that position would be down 28,180 at this level. So when somebody writes a naked put, they should be mindful of the advantages, which is premium collection, the advantages of time decay, but the disadvantages that in the event this person is wrong, they can incur a very large loss without limit. Now, one of the purposes of the option ranger is to say, well, let's look at this in a different way. Let's analyze the trade and maybe try to use a different market. So in this particular case, let me just go ahead and populate some of these fields here. So we're going to sell a put again, and in this particular case, we're going to go to the E-mini S&P market, because maybe the person, well, it's a lot of premium, but if it goes down to 1600, I'm convinced. I'm not that convinced. So then they use a different instrument with a different tick value. I'll input the same price. Now, as you can see here, this is a different contract. Instead of being 250 times, the index is 50 times the interest. So it's a smaller contract. You see the tick value is lower, and when we look at the spreadsheet, we'll see that the numbers are also essentially one-fifth the gain potential, one-fifth the loss potential. The markets are pretty efficient at pairing them up, so that's why we make these spreadsheets very neutral. So if you input buying a call, buying a put, the red lines, the green lines, the sweet spot, so to speak, change accordingly. So let's have a look here again. In this case, the premium collected, now the math is done with the different tick values at 1375. And after you factor out fees, so the next net the person collects is 1320. The break-even on premium is 26.4, and the futures is at 1713.6. So we have the same numbers, and now you'll see essentially again how it has a similar look, this business of selling a put. You've got a level that above that level you have a potential for pretty good but limited gains. So the gains are limited, but the range in which those gains can occur is greater. there is a fight against the market to overcome the handicap of the distance from the strike price, in this case 100 points away, and of course it has to be done within a certain time frame as time erodes. So on the one hand, as you can see, there's a bigger range. However, that bigger range again is exchanged for the higher level of risk if this market moves explosively. And again, in this case, the comparison is to see how in certain cases a person may be well advised to use a different contract if they have a different level of risk. So now for somebody who says 1600 is outlandish, but I can handle this. I can't handle the large contract, or it will be too much for me if I want to diversify, then they can go ahead and use the smaller contract. And again, statistically, like an insurance company, they might do this a number of times, as long as they keep the premium more than they give any of it back, with staying power and with margin tolerance. This is a trade for the seller to consider. The buyer, on the other hand, also would have to understand the extent of a move that the buyer would need to achieve in order to become profitable. So as you can see, there are two people exactly on opposite sides. Those are the counterparties. The one person who thinks the market is going to go down with rising volatility, and this person thinks it's going to go up with falling volatility. So let's go ahead and finally, and I want to just go ahead and explain that for people who have too much, and we've been asked this question before. So somebody says, well, I really like this premium side. How do you cap the risk? There are strategies that are in our spread section and are also in our strategy gallery, which are past the basic option strategies, in which you can cover these positions by using spreads, so you still collect premium, but certain people, if it makes sense numerically, can also cover that unlimited risk with a lower priced option farther out of the money. So this is an example of selling a put on the market. Do we have any questions at this time?
Yeah, with crude oil getting to these levels, does it make sense to sell puts in crude oil?
Well, number one, you have to think about two things. Number one, and you'll notice how the question is so much in line, and thank you whoever asked it, with the way most people think. The question is, it's already moved a lot, is it time to sell a put? That is a bullish statement. What you need to, the other thing is, you need the volatility statement to say, I think it's dropped a lot, it may recover, but it's going to quiet down. There has to be some sense that whatever made this market drop so hard, so fast, that it's not just, you want to have the direction, but ideally you would want to have some sense that the volatility, whatever made it drop so much, is gone. And that, of course, that requires opinion and independent research. But in my opinion, depending on how bearish a person is or how bullish a person is, that is an acceptable strategy. So, for instance, yes, I would be in favor of selling a put in the case of one type of a risk taker. Another person that maybe can only should only tolerate a certain amount of risk on any given trade. Let's say some people don't like to risk more than 10% on any particular trade, or 5% on any particular trade in an account. So if somebody has a discipline like that, they might go ahead and do that as a credit spread, maybe sell a put closer to the money, and invest some money, so to speak, in reinsuring an out-of-the-money put that they buy, so that in case something really volatile and crazy happens to the downside, they have some, they have some cap on the risk in the trade, and then it can be fall within. So it's really, two different people have two different needs. But if somebody thinks either, I think the market's going to hold, but volatility is not going to go up. And in fact, I think volatility is more important now, because if you can sell, and I can pull up an example, and we can run a trade. Let's see, today, let's look at May crude oil closed at 97.99 up 31, but it's well under 100. It took a real dive. So let's go ahead and set up another trade and look at writing a put in this market and see just how much sense it makes based on how much we can collect and how big a move is required to become profitable. So let's go ahead and reset. I'm going to go ahead and reset the basic calculator. Now we're going to go ahead and go to crude oil. You can either scroll down or you can start typing. It populates. The strategy is going to be selling a put. The number of contracts, we're going to use 1. The strike price. Let's see, the market's at 9. Let's see if we can sell an out-of-the-money put in this particular case and collect enough money and have a sense of some sort of a cushion before the put goes intrinsic or before, with rising volatility, the premium inflates. So let's have a strike price of, what is the May 94 put?
Currently it's 88 at 90.
Okay, it's 88 at 90, so we're going to split it and call it 89. 88 at 90 is the bid and ask. So usually if you have the access, you want to work some sort of a price. We're just going to make up a price now that got filled somewhere in the middle, factor in some costs, and let's go ahead and calculate the trade. Again, remember you have all the links here to the contract specs and a further discussion of in, at, out of the money options. This is an out-of-the-money put, and we'll look at some different strike prices later on to compare and have just a real quick look at how intuitively this works. Okay, we have the contract specs on the trade. Whoops, I think somebody made a mistake with their inputs. Timeout. Okay, let's go back to the calculator. Oh, and I see what happened here. Perhaps this should be a 0.89. Okay. Yes, so in this particular case, as you can see, it's 1,000 barrels, so it's 1,000 times, so a $1 move times 1,000 barrels is $1,000. In this particular case, the premium points collected was 890 minus fees. It's a net of 835. The 835 is the max that can be made on this particular trade. Okay, how many days? When does this position expire, by the way?
In 34 days on April 16th.
Okay, so in 34 days on April 16th, if the market is, let's see where it is, if it's above, what's our break even? It has to be above 93.16. If it's above 90, if it's above the strike price itself, then the entire premium is kept. So if it's above 94, the 835 is made. The person is betting it's going to stay above 94 between now and April 16th. Then we look at the risk and reward, and sure enough, as you can see, as long as it's up above 94, the maximum that can be made is made. If it goes to $150, you just get your 835. On the other hand, there's a little margin of error under that 94 because of the money that was collected. So the first money that's lost when you write an option is the money that you collected. After that, of course, then you know you begin to incur real losses. So as you can see here, based on the drop, the numbers are incremental. There's no limit. The lower it goes, the greater the loss. Now, if somebody said, you know, I don't really think that there's any way this market's going to go under 94, maybe 93, and this is all kind of a tolerable zone as a negative scenario, fine. But what you should be looking for is a bullish market and falling volatility for a sweet spot. So I would say in this particular scenario, with 36 days to go, that's the opinion that would be measured against both the futures break-even or the contract break-even in the case of a or a stock price break-even in the case of a stock, and within that time frame. Now, let's say somebody said, you know what, I just like a little bit more breathing room. I don't mind collecting less money, but let me try another one. So somebody says, let me go sell a put, but I want to sell the 93 put. Give myself a little more breathing room, and I don't care if I collect less. Okay, and how much would that be?
It's trading 68 at 70.
Okay, so it's still 68 at 70. Okay, let's call it 69. Okay, to split the bid and ask, and we're going to hit the calculate button. Okay, and as you can see now, it's at 1,000 barrels times 69 cents. It's 690 minus the fee. So this person collected a net of 635. The profit potential is less. That's the maximum the trade can make. But the break even now is at 92.36. And the previous time, and again, all these trades get saved in this column. So you can very quickly compare these two side by side. So let me see. This one had a break even at 92.36. And this one, just a moment, has a break even at 93.16. So as you can see, there's a greater margin of error on the second trade, which collects less money, has less profit potential, but on the other hand, the risk scenario begins at a lower level. So whereas in the previous case, 92.50 would be a place where the trade would start losing money. On this particular grid, it's still making a little something. And of course, the risk scenario continues to move down by $1. So in many cases, the decision would be made two ways. If a person feels pretty strongly about the trade, they're going to write really close to the money. And they'll still have a margin of error as a cushion. So let me just do the final example, and let's go to 95. The market at 97.99 presently, this is still a put option that is $2.99 away from the market. So again, somebody who feels that the market's going to rally, well, that's simple. Or it's going to rally, but if it drops, it's kind of not going to drop past that point. That's the place to look at this kind of a trade. And again, the closer to the market you get, the more bullish you're being, and the greater and your expectation that volatility falls would be even more confident. So as you'll see, you calculate the trades, and at some point you come up with the market that hits your range. Now this, hold on, let me just change the, how much is the 95 put, please?
113 at 116.
113 at 116, let's call it 114. Okay, and let's go ahead and calculate the trade now, and oh, well, oops, timeout. Oh, 1.14. I'm really glad this very helpful premium box appears over here, and I should look at it. As you can see here, you're going to get the expression, so it's 1.14. Let's go ahead and calculate. And in this particular case, it's obviously we're collecting more. It's 1,140 less fees. That's the maximum profit potential of the trade is 1,085 as listed here. Again, when you sell a put, it's a margin trade. So it's $10 per tick below 93.92 intrinsically, and we get the contract basics, and here we go. Now, as you can see, if this person is right, the market actually goes up, goes up, goes up. They keep the premium. If the market goes down, now as you can see there, because they sold the put closer to the money, they collected more. So what's the real bottom line? Bottom line is that the futures break even is at 93.92 at expiration. So while monitoring premium, of course, you're always monitoring premium, because you can offset a trade before expiration either to limit losses or to maximize gains, or just because you don't want to be in the trade. So the way to offset prior to expiration is always by tracking the premium that we have here. However, another way in terms of trying to look at this from a directional standpoint, how far will the volatility have to go, is to look at the actual futures break even, which is a tad under 94. So this trade is collecting money. It's collecting more money. On the other hand, it is also bringing the risk closer in the event that the market breaks to the downside. And again, past a certain point, it's tick for tick. but the break-evens and the sweet spots really do shift based on how you select your strike price and how different options are priced. Any other questions?
That's all that we have right now.
Okay. Thank you all for attending. Thank you, Roy, for providing the prices, and we'll be doing a program tomorrow on the VIX contract. I think with what's going on around and talking about volatility all the time, it'll be interesting to have a look at the VIX, and we'll be looking at the VIX on the S&P. So I look forward to speaking to you all again. Again, if you have questions, contact us, and be sure to check out, especially on our library as a reminder, be sure to go to our demonstration section, our reference materials, where we have definitions, more videos, and further contract information. So thanks again for attending. Keep on learning.